My name is David Fauchier. I'm the CIO at a firm called Cambrial Capital. We're a fund of funds in the space, and we focus on market neutral. And so we don't actually do any trading, but we look at a lot of funds all day long that have issues around market structure, need things like prime brokerage, custody, et cetera, et cetera. And so we've got a wonderful group of people from actual trading funds through to service providers to sort of give us a perspective on the space in general and where we are versus the traditional kind of launching a traditional hedge fund in this space. And if we could do some very, very quick intros from each of you, starting with Dmitry, just one sentence about what you do.
Sure. Hi, everyone. Dmitry Tokarev here, CEO of Copper. We provide trading and safeguarding infrastructure for predominantly buy-side players, asset managers, high nets, ultra high nets, wealth managers, etc., as well as providing within those inter-exchange custody. It's probably the only player out there who does that today. And yeah, very excited to chat today about I wouldn't call it the rise, maybe emergence of the prime brokerage as a service.
Yeah, hi, Martin Garcia. I'm a managing director at Genesis. We are an institutional trading and lending firm based in New York and New Jersey.
Hi, I'm James Bennett, CEO of ByteTree. We're a crypto asset data provider. We provide data for research, investment and trading strategies, so we're more on the sort of service side around the prime brokerage rather than actually executing the trades.
Hi, I'm Michael Hall. I'm the CIO of Nickel Asset Management. We run a digital asset arbitrage fund, and we've just launched a long-only fund as well.
Thank you. To kick things off, so Michael is one of the few managers that we actually meet in the space who's built his own hedge funds in the past before. He was in fixed income trading for 20 or so years at a few places. And to kick things off, if you could just sort of talk about, you launched Nickel in June of 2019. If you could sort of compare and contrast the differences between launching sort of traditional hedge fund and the sort of unique challenges that you had in launching Nickel.
Okay, so the first big difference between trading, say, fiat and crypto is crypto's 24/7. Markets don't close at 3 o'clock on a Friday afternoon and you go home and you relax. They keep trading. So you have to build automated trading systems to trade those markets when you're not in the office. One has to build risk management systems to manage that risk when one isn't in the office, when the markets are trading. And you have to build collateral management systems. As your bots start to trade, they start using collateral, and that has to move from one place to the other. So there's a lot of automation takes place that you don't have to have if you're running a typical fiat fund. One other issue is custody. And because it's so easy to recover fiat if someone steals it, but it's so difficult to recover Bitcoin if it's taken, custody is a huge issue. And every one of our investors wanted to know how we did our custody. When I set up my fiat fund, nobody asked who our custodian was. It was HSBC, by the way, but nobody was interested. But with crypto, custody is very, very important. And there are two risks. One is that our custodian gets hacked, and the other risk is that we, the investment managers, steal it ourselves. And so we had to come up with a system that could stop ourselves from stealing the assets that we were managing. And you've got some great custodians out there, and these custodians will do that very well. But when those assets go to an exchange, and those crypto assets are on an exchange, typically the investment manager controls that exchange's username and password. So they can take the assets from that exchange. So we came up with Copper, a solution that Copper calls the walled garden, to stop that from happening. And so with that, we were able to launch our fund. Had we not had that, we wouldn't have been able to launch our fund, because we wouldn't have been able to tell our investors that their money was safe.
I think the fact that crypto is a bearer asset sort of introduces all of these interesting challenges in commodities, which a piece of grain is also a bearer asset in some sense. You can trade sort of receipts against those. In crypto, we don't have that today. And as a product of the history of crypto, you're just sending these to an exchange and trading them. And Dmitry, I know you've got a good story about an exchange recently and a bug you guys found.
Yeah, I need to be really careful what I'm saying. But from the standpoint, we'll have another custody panel today, which is probably going to argue MPC, multi-sigs, et cetera, et cetera. But in reality, if you have an API, you can pull that API, you can take the crypto. Doesn't matter whether it's sharded in the end or it's HSMs in the end, etc. If there is an API, there is a vulnerability. And if you look at all the exchange hacks, which are public, they all happen to be hacked through public APIs. Convincing an exchange, a system that you have that crypto, then it's easy to withdraw because the system believes you have that crypto on a software layer. So the rest doesn't matter, right? So, from our standpoint, we helped one exchange, basically one of the, I can't say name, but top 5, not to, to plug the hole which has been there for quite some time, not to get their hot wallets wiped out. As a test, moved out 300 grand. We returned it, of course. But I mean, that's something we generally don't talk as an industry, right? Because it's I would say, kind of an elephant in the room and dust under the carpet. But if you think about it that way, 280 billion market cap today of crypto, since last DAS, that hasn't changed. Still less than total market cap of Polish stock exchange. So sector is extremely small. If we want to grow it, if we want to attract more institutional money into it, we need to change some of the infrastructural challenges. And a challenge is the following. When funds go out and fundraise, they obviously need to declare what kind of credit risk investors are taking, whether it's with them or their service providers. And since the infrastructural challenge that you described is in place today, when you have to have funds and exchanges, you have to take the credit risk of exchanges, which is extremely difficult. If you're a fund and you used to go out to pension funds and other large asset managers, like Scottish Widows, not going to take a counterparty risk of an exchange which is based out of Seychelles and unregulated in any shape or form. So that's number one. Number two challenge is the sheer quantity of that counterparty risk exchange you're taking. We integrated with over 16 exchanges, which is cover 96% of volume globally, real volume traded, and 16. How much operational risk due diligence an investor should conduct? That's also a problem. Another problem: minimum ticket sizes are 5 million sometimes, but there is another restriction. We can't be more than 10% of your fund. So you need to have a fund which is 50 million plus, which a handful only out there. So from that standpoint, we strongly believe that this year, definitely we will migrate towards more traditional infrastructure, whereas funds don't need to move out to the exchanges to be able to be traded, because that will allow more capital to come in, more volume to come in, different financing options will also become available, and different products could be built on that infrastructure, which will stand basically at the very base of it, basically. So that's kind of like high-level thoughts.
So I think what you're saying is, if you can move the settlement off the exchange.
Correct, yeah, off-exchange settlements.
So somebody would store, a fund like Nickel would store their assets with you, and that would serve as the collateral.
Sure,
for the
with us, other custodians, yeah, absolutely. And then essentially you conduct the trade or not, and then you can basically send a settlement instruction and get the trade settled. So that way, exchanges de facto are custodians. They're just not being paid for it and taking all the risk. It's a very bad business model.
Do you guys have a sense for whether they would want to do that?
Some of them do. More the ones that are coming from traditional sector realize that, and it's a no-brainer for them. To some of them, you look at the backgrounds and you understand that we need to spend 3, 4, 5, 6, 9 months to describe what settlements are, and clearing and how it works and why it's important. Because in reality, you have final decision makers, which are not buy-side players either, basically. Because the final decision makers are LPs, you guys. You decide whether you're going to give the money. So, and there is a lot of smart people, all in this room and generally on the buy side, but they're struggling to bring in more capital. And to bring more capital, you need to have a proper infrastructure. So I think if we're going to be looking into running funds which are over 5, 10 millions in size, because management fee on 10 million is not going to pay for electricity. So we need to have that infrastructure in place so we have the sizes which are necessary for this sector.
Yeah, I think what's missing in a lot of this is the treasury management function that you're kind of hinting at. There's liquidity in different pockets in this space, and how do you take advantage of that by having access to your capital on across these different platforms? so we're a wholly owned subsidiary of Digital Currency Group. We started trading, Bitcoin out of our broker-dealer back in 2013, and here was this, novel asset that was going to change the world, that was, all of these, cypherpunks and, crypto enthusiasts and super, super technical people, and the way that that it was traded in size was literally over the phone, or, through a Skype message or a Bloomberg chat. So I think that just across the spectrum since the beginning, it's been, a less technical solution has kind of been there. And I think that where we're starting to see things go is a more fully integrated, being able to access, pools of liquidity across different exchanges and venues that really will be a huge help.
So question maybe to you and Michael, which is, so Dmitry was making the point that, the LPs are asking for it, therefore the funds have to ask the exchanges of it. But Michael, have you ever had dialogue with exchanges trying to push them in a certain direction, for example, with off-exchange settlement? And for you as well as at Genesis, these are also counterparties for you guys, I imagine. Are there people that you refuse to work with, or where you're able to actually affect change in terms of their best practices?
Sure. I mean, we're speaking to 2 large exchanges that you would have heard of now about off-exchange settlement. It's a win for the exchanges because they currently do custody for free. In fact, if you're Binance, they paid $40 million last year to do it. They got hacked. So if you're Binance, you pay money to do custody, lots of it. For us, the biggest risk we take is the risk of exchange counterparty credit risk. So we take a look, if we can get rid of that risk, that's great. And the custodian gets to charge fees. So the exchange gets its custody done, which is a cost center for them, for free. We take away our biggest risk, and the custodian gets to charge custody fees. So it's a win for everybody.
There is another thing which has also been discussed before, is the speed. We're all chatting about how quickly you're going to get the assets out of cold storage and everything, but everyone's keep forgetting that the transaction needs to be cleared through blockchain, which takes 2 to 20 minutes to 1 hour sometimes if you messed up the fees. I mean, then it doesn't matter whether it's a hot wallet, which is instantly going to move your assets, or whether it's will instantly initiate the transaction and broadcast the transaction. Or it's, like us, we get it out of ice cold storage within 10 minutes. So you're still going to have to sit and wait for the blockchain to clear the transaction before you're going to trade. 2 minutes is in a long time in your strategies or statistical arbitrage strategies.
Yeah, I mean, I think that in some ways we're victims of our own success, and that the reason why we maybe have been slower to integrate some of these things is because most people that are in the space now, they bank with 2 banks that have an instant settlements layer that allows you to settle. Many of the exchanges are using that to allow, transfers, which kind of helps, grease the wheels a little bit so that you can move assets, a little bit. And there's OTC desks like us that allow for, the trading in good size with really minimal amounts of slippage, where if you look at kind of OTC versus, more like a commission-based, execution, with how competitive the space is and where spreads are, it's really, really tight. So you can move in really big size, very tight to spot. So it kind of eliminates, and then settle with a stable coin or an instant settlement layer where it's real time 24/7.
Could you talk numbers and names? So give us maybe an example or 2 for people who aren't too familiar with structure.
So the 2 banks that I'm referring to are Silvergate Bank, which is out of La Jolla, California in the U.S., and then Signature Bank, which is out of New York, which is, in the space are the 2, kind of largest players in the space, where the majority of the, crypto funds and OTC desks and exchanges bank.
Can you give us a typical trade that sort of exemplifies these, the need for the Silvergate Exchange Network and instant settlement and things like this?
Yeah. So, if hedge fund XYZ, wants to execute a trade through the desk, they basically come in either through API or through some kind of an RFQ mechanism, and gets a real-time quote or a 2-sided market, we agree to price, and then assets are exchanged, immediately. We settle most of our trades, within 15 to 25 minutes of when they're executed. So the time between, a trade and settlement is really quite quick. With the, emergence of our lending desk, you then have another layer where you can effectively utilize leverage, where you can, sell short or you can lever long. So it really kind of helps, add more capital to the system when you are a kind of a sophisticated fund running sophisticated strategies. What it doesn't have is you still have to have this 24/7, balancing act going on in the sidelines, because you never know when the volatility is going to come or what's going to happen that could, impact the strategies that you're running. So you do have to be prepared for those things. But when it comes to execution, there are a lot of different players out there that you can utilize to get really, really great service and really great execution kind of across the space.
Can you give us a sense for the kinds of block sizes and spreads that you'd be paying? I think that always surprises people who aren't familiar with the space.
Yeah, so I mean, for like a $5 million, $10 million block, you would see it, even 25 basis points wide bid to offer.
Is this on Bitcoin?
In Bitcoin. And that would be that's how competitive it is, when it's super tight. That typically is swayed towards the direction of the desk. So it might not be, 25 from mid, it's 25 from the direction that the desks feel that it's going.
I mean, the spreads collapsed massively in the last year. We work with like several liquidity providers out there, where we basically bounce them off each other and get the spreads as tight as possible. We run an agency trading desk, not principal one. So that from principal standpoint, it got very, very hard to make money in this market. But again, like use case you're describing facilitates I wouldn't call them funds, probably like family offices or miners who wants to buy and sell BTC. But the thing is, it's like Silvergate and Signature, yeah, it's fiat rails, great. You can move fiat within there. What if you need to move the funds out of BitMEX and it's past 1 p.m. cutoff time? Like that's the problem that any other fund out there will be struggling with. So I think, judging the sector progression, like in 3 years, we should have built something more than just buying and selling BTC out there. I feel like as an industry, because it exists in traditional space and, on such rusty rails, but it works better there than in here in this young, new, tech space. So from that standpoint, I would just argue that it's definitely been solved for BTC in terms of like if you're a family office, call OTC desk. There are thousands of them out there, and get the best price and buy and sell BTC. But how does the fund I don't know any kind of like long only directional BTC fund. I don't know actually any directional funds out there that has more than 5 million in assets under management, because investors just looking to generate returns which are superior to the market. Otherwise, that you can just long only BTC fund by nickel, and from that standpoint, they're able to tap into those exchanges directly and get the tightest spread themselves, so they don't need an OTC desk. So, from that standpoint, I would say there is still massive underserviced buy side number of players there, which needs to be changed.
Is that your experience, Michael?
So the way we buy and sell crypto is we run consolidated order books. So we take feeds in from all the exchanges, including the derivative exchanges, who tend to have deep liquidity. And then so when we trade, our EMS automatically sends orders to the best located place. And we obviously put in fees into those as well. So we see the exchange ranked by fees, and we make a slippage adjustment because some exchanges have better APIs than others. And so we find we get better execution. On one, they'll have a lower slippage adjustment than others, which have robust, which their APIs aren't as good. And so they'll have a higher slippage adjustment. But yes, I think that generally we get pretty good execution without going through OTC desks, but that's because we've put a lot of time and effort into building these systems, because we have to do that for arbitrage. Because arbitrage, we have to be quick, we have to be able to buy and sell between different exchanges in very short time frames. Therefore, we need those kind of systems. But your typical long-only fund doesn't necessarily need to build systems like that. If you're trying to make a 10x return from buying Bitcoin, it doesn't matter if you pay 20 bips. Too much.
And so changing tack a little bit, I think one of the interesting things in the market structure in crypto is if you think of equities and you want to buy Apple shares, you can do so on the New York Stock Exchange in the US. And that's really the only sort of lit exchange or place that you can go and buy and sell. In crypto, we have like 100 exchanges with real liquidity spread all over the world in different countries with different operations, different regulatory regimes, and all of them typically are listing Bitcoin, and they'll typically do so against a fiat pair. And you'll have Ethereum trading as well, and that'll trade maybe against fiat, but also against Bitcoin. And so you have many different places that are all listing the same pairs, and that have different people trading on them with different volumes, et cetera, et cetera. And so one of the big issues that we see some funds facing is actually like, what's the price of Bitcoin and USD at a given moment in time? And so this idea of like, how do you come up with robust and reliable data is a really important one that, James, I'd love you to speak to a little bit. And I'd just say that I think the SEC, in rejecting the ETF proposals for Bitcoin in the US, one of their main criticisms has been, well, how do you set the price and show us a robust index that can't be manipulated? So it's not a theoretical consideration, it's a very real one. So this is what you guys focus on.
Yeah, no, it's a really good point. I mean, because the price of Bitcoin can vary so much between exchanges. I mean, I remember seeing the sort of kimchi premium in the Asian markets where we were seeing.
Can you describe what that is?
So in the Asian markets, Bitcoin was essentially trading at about 10% premium at some points in 2017 versus more open markets in Europe and in the US. And so like actually where you're sourcing your price from for your indices and for your products can make a massive difference in terms of what you're actually buying at. So yeah, there's like now today we don't see such a big variation in the price, but it is still prevalent. And then when in order to get a good price, you're trying to do your volume-weighted average prices, but obviously then you're dealing with volumes that aren't necessarily legitimate. So how can you create a volume-weighted price if you can't verify the volumes on that exchange? So like it's really a bit of a cat and mouse where you're constantly trying to find ways to identify which exchanges are genuinely reporting proper volume numbers and should be considered for your pricing indices, and those which shouldn't.
And on sort of a volume-weighted basis, to the best of your knowledge, what does transparency look like?
Transparency
that you can get from an exchange, because I assume you do some level of DD or analysis on the order books and try and figure out, both from meeting maybe with management or understanding more about the business.
Yeah, there was a report that Bitwise did, I think it was probably 2018 now, where they were looking at the fake volumes across different exchanges and saying about 90% of exchange volume was actually fake. But in reality, they were trying to claim that there were certain patterns in the exchange data that demonstrated it was kind of sort of an AI or like roboticized. But at the end of the day, it's quite hard to actually pick what is genuine volume versus fake. And so at the end of you instead want to create some kind of criteria of which exchanges are robust and should be considered as sort of legitimate. Based on the jurisdiction and the transparency that they have in the community and different governance structures they have and so on. And there have been a few sort of strong reports out in the industry. Crypto Compare did one in particular that is sort of a gold standard at the moment for picking which exchanges you can trust the volume from.
Okay, thanks. Another issue is margining. We see, this is something we hear from funds a lot. You can get margin, between two positions on the same exchange sometimes, but sometimes not even that. Could you talk a little bit about kind of cross-margining, and this is really for anyone, portfolio level, between exchanges, how that might work?
Well, we currently do this only on OTC settlements, so we're able to provide that. But for this, and correct me if I'm wrong, but for this to be properly flourishing, we need to realize off-exchange settlements first, so then you're able to. But again, it gets a little bit complicated, because obviously the positions are open. There could be a derivatives position open, there could be spot position open, there could be a part of a larger position. So I guess Michael could describe this a little bit, because we just talked about it. I think you had some interesting thoughts on that.
Oh, on cross-margining?
On the cross-margining, yeah, when you have a different position open in different exchanges.
Yeah, because so some exchanges will let you do cross-margining. What that is, that's offsetting one risk against another risk. So for example, on a derivate, when you're trading options and you have a large option delta, they will let you take a position in the perpetual swap, and they'll let you cross-margin that. So you'll pay you'll pay your net risk, if you like. So if you have if you have a large delta on one and an offsetting large delta on the other, then that's zero delta. You'll still have to pay some margin because you have other risks like Vega and risk and gamma risk, but your delta risk is zero, so you'll pay a much lower risk by having that. For cross-exchange margining, i.e. one exchange like being long on BitMEX and short on Deribit, that's not happening, and I think it'll be a long time before that happens. But that's the current state of the market.
I guess also within margining, what's pretty cool feature is maybe will be realized this year, maybe next year, but is the collateral autocall. So when you're able to basically autocall the collateral straight out of custody, essentially. Mm-hmm. So if you have a position and you're being very close to be liquidated, but you actually have more funds available in your wallet, so you can lock more collateral so that you still keep the position. Because more often than not, this position is complemented with another position which is open elsewhere, so that you want to realize basically the P&L on both of those legs rather than on being kicked out of one and then having directional risk of some kind.
So we have a lot of volatility in the space, and what kind of collateral do you require? How capital efficient is it if you want to get leverage?
We put all of our counterparts through a pretty intense underwriting process. Really understanding what the use case is of the assets that they may be borrowing, and most of everything in the space now is over collateralized or collateralized 1-to-1, just kind of across the space. It really depends on the strength of the counterparty that we're facing, so it really looks different from counterparty to counterparty. But getting back to the cross-margining, I think that's one of the places where the current lending desks like us, what we're seeing is people using an institutional lending desk to obtain that leverage that they can utilize, across the exchanges that they're using, and kind of using the speed and the efficiencies of the settlements layer that kind of we have built in to take advantage. But as far as like what a typical borrow looks like, typically about 1.2x in collateral is what we require.
Okay.
To take something off platform, mm-hmm. to take assets.
Got it. And the market structure in crypto is very, very different. It's sort of very direct. You have a fund trading directly with an exchange, or actually multiple exchanges, and they have a separate relationship with the custodian, and the custodian may not have a relationship with one particular exchange they're using. Do you guys, and this is really a general question, do you think the market structure in crypto is going to converge with what we see in traditional markets, or is it just going to be different sort of forever and have its own sort of parallel path?
I think that what you're seeing just and what you hear just across the number of people that are looking at prime brokerage as a service, ourselves included, as I think that people generally do think it's going to go towards that model. I think that we still have a long way to go. There's still, we have been, saying that, the big institutions are coming, since 2017, and really the only, super large institutions that we have in our space are the really big high-frequency trading firms. Those are our biggest institutions that are in our space right now. And yeah, we have dribs and drabs of pensions and endowments and some really big investors that are in the space and care a great deal, but we're still very early in the trajectory of where we're going. And I think that we look at servicing kind of the existing clientele that we have, providing that great service, and growing with them, because we don't really know when the other shoe will drop, so to say, on when this space will really have the abundance of institutional investors that we all know are very interested in watching this space. And it's kind of a chicken and egg problem. Like, are they going to come, before? Are they going to wait until after it's built? That remains to be seen. But I'm interested to see what others may think as well. But I think that that's generally the direction that I think everybody is rowing.
So you think we'll see sort of like proper white glove institutional PBs?
Yeah. I mean, everybody wants to
Traditional
be
space.
the one-stop shop.
Yep.
You don't want to, and you will do those businesses, at a break even to get business in other parts of the pie. So I definitely see it continuing to go that direction.
I hope that we don't look like the traditional space because we have direct access now to the markets, to the exchanges. If you want to trade on the CME, you've got to open an account with an FCM, Interactive Brokers, or JP Morgan, or one of those guys. But if you want to trade on BitMEX, you can just open an account directly yourself. And you don't have to go through somebody who's going to slow your trades down, charge you a fee, and potentially front-run your trades. I mean, if you're a hedge fund who has alpha and you think you have alpha, why would you show that to someone else before every trade you did? You're just asking to be picked off. So, and one big advantage that the tech or the crypto sector has is it's starting in a green field. HSBC apparently still has systems that run on COBOL. I don't know if anyone remembers COBOL, but it's a very old language that was written in the 1960s. But they still have systems because they just can't turn it off, because if they turn it off, all their ATMs go down. So the advantage that crypto has is you can build from scratch. Everybody has APIs, everybody's very technically aware, and we have a blank piece of paper. We can start building it from scratch, as it should be built for a 24/7 trading system. We've had very large financial institutions in our offices asking us, like, how is crypto different? What is it like to be a crypto hedge fund? And when we've explained to them the 24/7-hour nature of the business, the movement of margin, what we're trying to do about automated margin movements, they just say, oh, we don't have any of that yet. And they're looking probably at a runway of 2 to 3 years before they have that ready. So crypto has a big advantage, and we just have to just go for it and make sure we build these very good, real-time, accurate, precise systems that talk to each other that are 24/7. And then it's a huge opportunity for us.
Do you think that other asset classes, do you think that digital currency could be the model for other asset classes, traditional asset classes?
For sure, because they'll tokenize those assets, and they'll say they run better on crypto rails than they run on fiat rails. We can move crypto around the world really quickly, but to move fiat around the world can take a day or two. And so that's how I think it will go. I don't know how it will go, but it looks like that's an obvious direction for it to go.
Yeah, I mean, I agree with a lot of what you're saying, and I think that, when we look at, being a service provider in the space, how do we keep providing great service to funds like yours, and, while having an eye towards, the future and being able to service, there will always be people that need that full service. They need that one-stop shop. One of the crazy things, in the early days was that, here's this great space where you can be your own bank, where you don't need anybody else. It's don't trust, verify. And all these people wanted, and they're buying, large positions, is they want a trusted third party. And this is a space where it's the amazing thing about this space is that you don't need that, but we still kind of from the traditional angle want it. So it'll be interesting to see kind of that marriage of people that are connecting directly next to people that are connecting through copper or through whatever we build in the future, what have you. And it's going to be really interesting to see, and I think it keeps the market very honest and transparent because you have the ability to connect direct, or you can go through. So if somebody's front-running your trades, and you're running through their software, you're gonna know about it pretty quick.
Hopefully.
I want to leave a bit of time for questions, so I'm going to just ask you guys. Oh, sorry.
Yeah, so just a point on sort of institutions entering the space, and I think a lot of the infrastructure that we're talking about with prime brokerage does enable that confidence for bigger players to actually get investing in the space. But we need to remember that is particularly relevant for the tokenization of sort of real assets. But ultimately, we're still talking about public blockchain sort of crypto assets, so the likes of Bitcoin and Litecoin, Ethereum and such. And so how do we sort of bring more legitimacy and interest to the market, to that market and to crypto assets? And I think that's where sort of on-chain data and metrics really sort of help power the conversation, because typically what we've seen as the public awareness of our space is that Bitcoin is used, on dark nets and for money laundering and for all these bad purposes. But actually, we know now that that's not particularly true. There's about 1%, of Bitcoin that are used, in darknet markets. But then aside from that, we've got sort of 99%, which is, about $2 billion a day of transactions taking place over this global digital settlement infrastructure.
Can you talk a little bit about how you sort of pass through the on-chain data, what you're looking for, and how you can get to those kind of numbers?
Yeah, so I think there's three sort of key areas where on-chain data is really relevant. One is in the research, which is legitimizing the space as a whole, the assets, the economic throughput. So saying that there's about $18 million of revenue generated by miners each day, 300,000 transactions taking place, about 20 million active entities. Then you've got the sort of investment and trading strategies where you're looking for particular signals in the transactional data, which could either be whales moving large portions of Bitcoin to low liquidity environments where you're going to see a big change in the price, or investment strategies you're looking sort of longer term at like network demand and network effects. And there's been a lot of, to Dmitry's point earlier, I think there are Bitcoin only long funds. We see Grayscale, we see CoinShares, we see the likes of Pantera and some of the biggest funds in the space that have Bitcoin only funds. And I think this sort of on-chain data argument allows them to increase their sort of net. So sorry, we've got research, we've got trading and investment, and then the third one would be kind of compliance and regulation. And at that level, you start sort of using different heuristics to label addresses and relationships between addresses, and seeing certain behaviors. So in terms of the darknet, that wasn't our study as such, but in terms of the 1% of addresses related to to darknet pools, you can actually map out the web of connections between different addresses, and you can see that all on the blockchain. It's something that's so unique to this industry that is not seen in the commodities market or traditional asset markets, that you can see in real time what is the sort of economic activity and throughput and actions of different actors in this environment that we're all investing in.
Which is pretty unique to crypto.
And there's a fourth, there's another way that we use our data is we don't trust exchanges. So we check what they have. And we send crypto to an exchange. We know is that we can follow it as it goes through their hot wallets. We can see where it ends up. So we want to see what blockchain, what Bitcoin balances the exchange in which we trade have. And so we use this data to kind of do like an exchange credit check. Now, you'd never get that from the CME. No offense to anyone who's from those exchanges. You phone up the CME, say, how much money do you have? What's your credit risk? Can I see your bank statement? They wouldn't give that to you. But with Bitcoin, or with crypto, you can see that on the exchanges.
Yeah, as well, if you're depositing your Bitcoin and it's being lended out, it's filling that sort of secondary market, then you can actually prove it on an exchange address, and you can do proof of reserves, proof of funds, and it's you can't argue with that.
Kind of rapid fire. In the next 12 months, are we going to see counterparty credit risk largely solved?
It'll disappear from some exchanges who do it, and then the money will migrate to those exchanges.
So largely yes?
Yes.
James?
Yes.
Yes.
100% agree.
Okay. Robust indices and pricing. Will kind of pricing be a solved problem?
Yes.
We don't think pricing is an issue.
Yeah, I think we're
Well, so,
pretty much there.
you have like 7 exchanges that you trade with and maybe hold assets on, and each of those will have a different price on Bitcoin. But if you're valuing at the end of the month your assets, should you be taking a valuation of like weighted where your assets are across these exchanges, or the broader landscape of 40 exchanges?
So BitMEX has done a lot of work on this, and
Yeah.
they have an index, which is quite clever. If you look at how
Yeah.
BitMEX compute this, that is so far the best index we found in crypto.
How?
It's on their page, just Google BitMEX index.
Okay.
They exclude the outliers. They weight exchange weight is done by volume on the exchange. They've thought it through.
Okay. Any questions from the audience? And I think there might be some mics going around. Yeah, there's one now. We have one.
interesting enough you mentioned about counterparty risk on this and the forensics. I think there was a statistic that came out said that only about 1% of coin was available on the dark net, but through tumblers and everything else, a wallet can be contaminated even if just one of those hits through and it can be traced back. What's your kind of wallet rejection rate on the way in, typically, on an average thing? And B, given the fact that wallets can be traced, but association with owners of those wallets cannot be traced, do you trust the mapping on the databases of places like Chain Analysis that will do those, but essentially it's like Standard & Poor's and Moody's? Everybody relies upon it because there's no better database out there. How do you approach that?
Yeah, so I mean, on our side, on the trading side, we run our trading out of our broker-dealer, which is a BitLicense entity in New York, and also a FINRA SEC broker-dealer. So our KYC AML standards look a lot like opening up a brokerage account. So our, rejection on a wallet, is very, very, very low. That being said, we're running the chain analysis elliptic type checks on these wallets in real time. And while there is this 1% that is kind of this dark market or illicit activity, that is being funneled to exchanges where there is real volume, and that could be problematic. So on our side, the number of exchanges that we trade on is limited because of those potential KYC AML pitfalls. So it's just something that restricts liquidity a little bit, but it's why a lot of people enjoy trading with us as an entity that, hey, it's somebody who does KYC AML and you don't have to necessarily worry about some of these other things. But largely people have moved past that just because of how great the blockchain analytics are, and it's less common than you think that a wallet would be tainted, unless you're going to count exchange wallets as tainted wallets.
On our side, in a very similar fashion, every single transaction that goes into the platform we scan, and we rely on those companies it's basically their business model, right? So they probably have the best expertise. I think Chain Analysis' largest customer is FBI, so that's good enough of a standard for us as well. But we don't allow, the mistake that basically exchanges make, they allow those deposits to be tradable straight away. So, and then you can do it in the post-analysis check, but then that's already too late. So on our side, in a very similar fashion as well here, we've been operating like a MiFID II regulated firm, KYC AML for all sorts of funds. MLD5 is now in place. We operated on MLD4, so we didn't have to change a single bit basically in our processes, because we believe that the sector will be more and more and more regulated, and all the things that you've done before is also going to be accounted for to the same standards. So, but slightly coming back to the digital assets that we discussed, my background, I was a CTO before in an asset management company, and we built systems, basically a trading system, PMS, EMS, OMS, all of that connecting COBOL things, etc., which has been a nightmare. But every time new regulations come out, you have to do like the whole systems revamp, and you have to go, like MiFID II, for example, brought like 80 plus reporting fields, I think, after each trade. So in reality, blockchain is a blessing in disguise for the FCA or SEC or similar organizations, because you can get your full information down the line, not today, it's probably 2 years too early for this conversation, but down the line, you will be able to get the majority of that information live through scanning tools, basically Chain Analysis, ByteTree, Elliptic, and whatever they're going to be focusing on, so that it reduces the barrier to entry for the asset managers to conduct those activities.
Right, we are unfortunately out of time. Thank you very much, guys, and thank you.